Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
We're clearly living through unprecedented times. Or are we? What can we learn looking back at history? What should we learn from economic theory, and how did we get to where we are? I'm delighted to be joined today by Stephen King, the Chief Economic Advisor for HSBC, the world's trade bank. So I'm going to start with three questions and force you to answer either yes, no, or a qualified depends. One, tariffs can be beneficial.
That's a tricky one. Yeah, they can be in certain circumstances, but it's not something you'd really want to advocate most of the time.
Two, a trade surplus is preferred to a trade deficit.
In terms of economic theory, no, because the whole world cannot have a trade surplus with itself. So every trade surplus, there has to be a trade deficit.
That's not a depends.
No.
Three, a US trade deficit is the inevitable consequence of the US dollar being the reserve currency.
That is most likely to be correct, yes.
Let's unpack your answers. Take us through a little bit about the history of tariffs.
So tariffs can be used for, I would say, three main reasons. The one that has been dominant, I would say, since the end of World War II is to use tariffs to force other countries to change their policies in other ways, maybe to buy more imports from, let's say, the US, where otherwise had been the case, to open up the domestic markets, to allow more competition in those domestic markets. A second reason is to support what are termed infant industries. So if you've got an industry that is still relatively small compared with your international competitors, you haven't quite got the economies of scale, you use an infant industry argument to protect your industry in its sort of fledgling beginnings. And the third reason, very, very simply, is that you use tariffs as a source of revenue.
The US started with this, and I mean, at the point of independence, I think Alexander Hamilton was probably the biggest advocate for tariffs.
Britain, too, was an enthusiast for tariffs. There's nothing unusual about tariffs in those days. In actual fact, after the Napoleonic Wars, Britain came up with its own version of tariff protection in the form of the so-called Corn Laws to protect domestic farmers and landowners from competition from much cheaper grain elsewhere in the world. So effectively, the domestic price of grain in the UK was significantly higher than the global price, to the benefit of farmers, landowners, and the people who worked on the land. The problem with all this was, of course, that if you're paying more for your daily bread than if you're a manufacturing worker, a factory worker, as people increasingly were in the early 19th century, if you were in sort of urban situation, you're actually worse off as a consequence of the tariff. And one thing that's worth stressing here is that tariffs tend to be redistributional within the country that's using the tariffs. It benefits some groups, it actually is a significant cost for other groups.
In economic terms, it takes away the consumer surplus and moves it to the manufacturer, but even within the manufacturing sector, it redistributes, is your point?
Yes, so again, with the Corn Laws, landowners, farmers did absolutely fine, but if you were a factory owner, the problem you had was if people were spending too much money on their daily bread, they had less money left over to spend on the things that you were producing from your factory. So demand for your goods that you were producing was lower than it might otherwise have been. So there's a kind of redistributional effect that created winners and losers domestically, and it's worth stressing, led to significant political reform in the 1830s and 1840s, which in turn led to the end of the Corn Laws, the abolition of the Corn Laws.
And what happened to the agricultural sector at that point?
Well, at that point, it shrank significantly. So in the late 19th century, British agriculture fell and fell. The number of people employed fell and fell. But of course, this was more than offset by huge expansion of manufacturing over the same period of time. And it is worth stressing that often when you have a tariff, it protects a certain industry. But when you remove the tariff, that industry loses that protection. But the broader economy may actually flourish, which was certainly true of Britain in the second half of the 19th century.
But am I right in saying, so Britain after the Corn Laws actually moved towards free trade, but that was actually when America was quite protectionist?
So in the late 19th century, whereas the UK committed to virtually not quite zero tariffs, but very low tariffs, the US was pushing for significantly higher tariffs, partly because the North had won the Civil War, The North was the home of manufacturing, as opposed to the South, which was involved with commodity trade of all sorts involving cotton and tobacco and so on. And the North wanted to pursue protection of infant industries.
Let's look at a couple of big events in the last century. 1930, the Hawley-Smoot Act. Maybe completely different, but put in the same bucket often as the Nixon shock.
That came about in 1930 in a period when the US was already very, very protectionist. Tariffs had already risen in the 1920s to a significant degree. And it's worth stressing that although a lot of commentators tend to think that Smoot-Hawley contributed to the Great Depression, it may have done to a certain degree, but the timings aren't quite right. First of all, Smoot-Hawley was being discussed before the Wall Street crash in 1929, and the process of coming up with legislation predated the Wall Street crash. And secondly, the Depression itself didn't really get going until 1931 and was more to do with a collapse in the financial system than to do with the tariffs that came through. To cut a long story short, Smoot-Hawley was designed initially to protect US farmers who would be under tremendous pressure in the 1920s. But it's also worth stressing that US farmers were actually pretty inefficient. The share of employment in US agriculture was double that in the UK, which was in one sense a reflection of the underemployment or the lack of productivity of people in US farming. But the big consequence of Smoot-Hawley really was that as soon as the Americans had imposed these tariffs, other countries responded, and responded in a very, very big way. So the most famous example of this is something which came about from the British Empire, which was called imperial preference. And effectively, imperial preference was home producers first, empire or imperial producers second, everyone else third. So effectively, there was a kind of ranking of where Britain would trade, who with, and under what terms. And a number of other countries also imposed tariffs or quotas on US products. So actually, in many ways, the Smoot-Hawley tariff was a self-inflicted wound for the US, because other countries thought, well, you are the aggressor here, we're going to respond to you. And the overall consequence, of course, was that tariff levels went up dramatically and remained very high even after the Great Depression. They remained high through the 1930s, partly for political reasons, of course. And it wasn't really until after World War II that there was a process of dismantling those tariffs that had risen so much in the 1920s and 1930s.
And subsequently, we kind of went through a period with low tariffs till...
Well, they gradually fell. They weren't low at first, but successive rounds of what was called the General Agreement on Tariffs and Trade, so the predecessor of the WTO, contributed to a stripping away of tariffs year by year, decade by decade. So by the time you get to sort of the late 1960s, tariff levels generally much lower than they were. And then you have the Nixon shock that comes through in 1971, associated with the idea of the dollar breaking away from gold under the Bretton Woods exchange rate system. But it's also a shock that is associated with tariffs. Nixon wants to force other countries to revalue their exchange rates against the US dollar. There's a sense that there are widening trade imbalances. The US is feeling uncomfortable about a larger and larger current account deficit, which in those days, it was big by the standards of the day, although it's tiny compared with where we are nowadays. The idea was that the Americans, Washington, would threaten tariffs onto mostly American allies, so this is Japan, Germany, and so on and so forth, but with the sort of hint that if they were to revalue their exchange rates, the tariffs would then be removed. So by the end of 1971, the yen's quite a lot stronger than it had been. The tariffs are eventually removed. They last about 6 months or so. So as it turned out, the change forced upon other countries was probably smaller than Washington wanted. And so the revaluation of the yen at the time was really very, very modest. And there were two reasons for this. The first one was that a young Henry Kissinger was one of the first to recognize that other countries were planning to retaliate, a bit like Smoot-Hawley in 1930. And that was something that was potentially dangerous, because you get a sort of house of cards collapsing very quickly. And the second reason is that although I think Nixon had plenty of domestic political support for tariffs in the middle of 1971, by the time people began to experience the consequences of tariffs at home, so big increases in prices of a whole range of different goods in particular, public enthusiasm for those tariffs began to fade, because it became associated with higher inflation than had been expected. And so there was a sort of rather rapid retreat.
But the two or three things I think make the world very different in 2025 to even 20 years ago. One is trade in services is a significant percentage
Yes,
of global trade.
that's certainly
and
true.
trade in services moves across borders quite seamlessly.
And is much more difficult to tariff. So services may continue to open up. That's certainly
The second
true.
is obviously supply chains now crisscross a lot more. So the global supply chains it's not linear. So components going across borders, it's not as much as just tariffing the end product or stopping the end product from coming in. You got to rewire entire supply chains, which have taken decades to build.
One thing about that, though, I think, which maybe the US has seized upon, is that, of course, supply chains generally shortened during and post-COVID.
It's interesting. The underlying data doesn't always back that.
No, I fully accept that.
Because if you look at the average distance traveled by physical trade, mercantile trade over the last 6-7 years, the average traded good has gone up in distance marginally. So
Yes.
in some cases, supply chains have got longer and just less transparent.
Well, they may be longer, but they may be shorter in another way, which is that, for example, if you have trade between 3 countries, now you've got trade between 2. If the 2 countries that you're doing the trade with are further apart from each other, you may have a longer supply chain in terms of distance traveled, but actually fewer stops on the way.
But interestingly, I think where we've gone from trade between 2 countries to now trade between 3, because a lot of the low-value assembly is actually what's been outsourced. Just touch upon how the dollar came about to be such the dominant reserve currency. Because was it Keynes who proposed, what did he propose?
Bancor, which was an alternative to the...
On the IMF SDR, I guess, right, was what he was proposing, some weighted currency as an international settlement tool.
What Keynes had in mind was the idea that countries with both current account deficits and current account surpluses would be equally obligated to adjust their economies to remove the imbalances. What we've discovered in hindsight is that countries with deficits are sometimes forced to adjust because there's a sudden stop, particularly in emerging markets, a sudden crisis whereby capital no longer is coming into the country. It has to deflate its economy hugely to reduce the size of its current account deficit. But there typically is very little pressure on the current account surplus countries to adjust unless you're using American-style tariffs. So you come back to the 1980s, the Plaza Accord, what Japan subsequently does. Partly it's through the threat of tariffs that forces the Japanese to accept a stronger yen, but in other circumstances they probably wouldn't have gone there. Now, the peculiarity of all this is that Keynes's plan was rejected by the Americans because at the time, the Americans had a current account surplus. So they didn't want to be under pressure to if you like, have to adjust their economy. And of course, the boot is now on the other foot, that having not accepted Keynes's plan, now there's a recognition, and this has really started in the 1960s with the sort of so-called Triffin dilemma, that if you are the issuer of the world's reserve currency, you tend to run the current account deficit. The current administration will tend to say, well, the deficit shows that the dollar's overvalued, that other countries are cheating, and so on and so forth, and it's because of our reserve currency status. But I can think of at least one other country which has mostly had a deficit since, the last 30, 40 years, and no one's suggesting its currency is the reserve currency, yet it quite happily runs a deficit each and every single year, and that's Australia. Australia, in one sense, proves that the reason for having a deficit does not necessarily have to be because of reserve currency status. Nevertheless, the reasons why the dollar became the reserve currency was A, the collapse of the British Empire, B, the collapse of the gold standard, C, the fact that the US was the dominant victor after World War II, and D, that although the Soviets were initially involved in Bretton Woods discussions, it was clear that the Cold War was going to mean that there was going to be a separation of interest, which meant that for the so-called free world, the dollar was, totally, utterly dominant. And in terms of the Bretton Woods design, because the dollar was fixed in value against gold, and because all other members of the Bretton Woods system were supposed to either revalue or devalue against the dollar, and hence gold, the idea was that it was incumbent upon all the others to adjust their currencies. So in one sense, Bretton Woods was a kind of quasi-gold standard because the dollar was supposedly as good as gold. That all breaks down in 1971, and for a while, there's chaos. After the chaos comes Paul Volcker. chair of the Fed in the 1980s, determined to get rid of inflation once and for all. He raises interest rates in the US dramatically. Money pours into the US, so the capital inflows are very, very high. But in the process, he also reduces inflation steadily year after year after year. As inflation comes down, it's a bit like saying the dollar returns to being as good as gold. Because if inflation is low and stable, as it proved to be, then people are then more content to hold dollars. And what is striking is that in the 1970s, the gold price goes through the roof. In the 1980s, thanks to Volcker and the renewed credibility of the Federal Reserve and the dollar, the gold price begins to fall back again. The principle of international rules and international agreements founded with the Bretton Woods institutions has mostly worked well over the last 70 or 80 years.
Stephen, I'm conscious we could spend another hour going through historical incidents and lessons from economic theory. But the idea today was to shed some light on what we can learn from history, how we got to where we are. So thank you again, Stephen.
Thank you very much, Vivek.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.